In Chapter 19, we're going to deal with accounting for income taxes. For the most part in this chapter, we'll largely focus on making the journal entry to record income tax expense and income tax payable. There are some other accounting issues we'll talk about related to income taxes, but again, most of the chapter will focus on making one of these three journal entries right here. So there's really two questions in this chapter, or two basic questions. First, which one of these three journal entries are we going to make? And then, given that we're going to make these journal entries, what amounts are we going to debit or credit each account for? To answer these questions, we'll start by learning the fundamentals of income taxes. So when we deal with accounting for income taxes, we end up dealing with two different sets of rules to calculate two different income numbers. One of those rule sets, as we know, is known as US GAAP. The point of US GAAP is to provide useful information to investors and creditors. So we use GAAP, or these set of rules, to take these transactions, we summarize them and represent the transactions by computing what's known as accounting income. Accounting income is also known as pre-tax financial income or income before income taxes. The other set of rules we use is the tax code or tax laws. The point of tax laws is to ultimately push forward fiscal and economic policies. So under tax law, we'll take the transactions and we'll compute what is known as taxable income. The basic idea here is since GAAP and tax law have different purposes, generally, accounting income is not going to equal taxable income. The biggest difference is under GAAP, we use an accrual basis, and under tax law, we end up using, for the most part, a cash basis. The differences between accounting income and taxable income are known as book tax differences. These differences can be classified as one of two types. Right. One is permanent differences, and two, they could be classified as temporary differences. A permanent difference just means that there's some revenue or expense transaction. Generally, it will only affect accounting income, but it's never going to be recognized in taxable income. An example of this is just interest on a municipal bond or a bond from the government. The government wants to incentivize you to purchase bonds from them, so generally interest on those bonds is never taxed. However, companies are required to include interest revenue from bonds or municipal bonds in their accounting income. Ultimately, permanent differences aren't going to have any future tax implications, so they're not going to affect taxes in the future, so there's no deferred tax consequences. This probably won't make sense to you yet, but it will later on after we cover temporary differences. Permanent differences are very easy to account for, so again, most of the chapter, you're going to be focusing on temporary differences. This next slide just gives you some examples of permanent differences. I don't expect you to memorize these, but seeing some examples of permanent differences may help you to feel more comfortable with the topic. For now, just ignore permanent differences because it is pretty easy to account for them. We'll just focus on temporary differences because this really makes up the bulk of the chapter. Earlier, as we said, GAAP and tax law, they just take the transactions of a company and we use them to compute some income number. Again, accounting income typically will not equal taxable income. If we ignore permanent differences for now, really the only difference then between accounting and taxable income is temporary differences. A temporary difference just means we'll include some revenue or expense transaction on income, but we're going to recognize them at different points in time for accounting income and taxable income. As an example of this, let's just say we sell $10,000 worth of goods on account in 2018, And then let's say we collect on that $10,000 in 2019. Right. As I mentioned earlier, GAAP uses an accrual basis, whereas tax law, for the most part, is just on a cash basis. So in 2018, let's just say this is the only 2 transactions for the company in these 2 years. Accounting income would just be the $10,000 of goods sold on account in 2018. Whereas for taxable income in 2018, we didn't collect any cash, so taxable income will be 0. In 2019, for accounting purposes, the company didn't sell anything, it didn't do anything at all, so accounting income would be 0. On the other hand, for taxable income, we generally recognize revenues when we get the cash. So when we collect the $10,000 in 2019, taxable income will be $10,000. So if we look at the total income of this company over 2 years, the total income was $10,000. We recognize the $10,000 of income for accounting purposes in 2018 and 0 for tax purposes in 2018. However, this difference is only temporary because then in 2019 we've recognized the accounting or the taxable income of $10,000 and accounting income 0. So to kind of summarize this, if we just focus on temporary differences, all transactions will be included in both accounting income and taxable income at some point. It just depends on when. However, over the life of a company, taxable income would ultimately equal accounting income. Again, we're making the assumption here of no permanent differences. The timing differences between taxable income and accounting income lead to what we call deferred tax consequences. Understanding deferred tax consequences can be pretty confusing, so take a moment to digest this slide. Accounting for income taxes really boils down to understanding the relationship between taxable income and accounting income over time. Again, ignoring permanent differences for now, everything will be included in accounting income and taxable income at some point in time. It just depends on when. To understand deferred tax consequences, let's take a step back and look at the big picture. We mentioned that over the life of the company, it's going to report some set amount of income. That also means because everything's going to be taxed at some point, it will ultimately end up reporting some set amount of taxes. So really, a temporary difference, if it causes greater taxable income now, it'll cause a less taxable income in the future. Similarly, if a temporary difference causes a less taxable income now, that means it'll have more taxable income in the future. So just to summarize that up, so if there's greater taxable income now, because there's a set amount of income, that means there's less taxable income in the future. Right. Similarly, if we have more taxable income now, that means since to calculate the income tax is payable, we'll just multiply taxable income by the tax rate. That means greater taxable income now means more taxes paid now. Right. If we are going to pay some set amount of taxes over the whole life of the company, More taxes paid now means less taxes to be paid in the future. We can just reverse that relationship around as well, and it will still hold true. So if we have less taxable income now, that means there'll be more income or taxable income in the future. All right, and then again, less taxable income now means we're going to pay less taxes now. But if we're paying less taxes now, and there's a set amount of taxes to be paid in total, that means we'll pay more taxes in the future. Another way to say this is whatever happens now needs to reverse at some point in the future. So all else equal, right? If right now our accounting income is less than our taxable income, then that means in the future that this relationship must reverse and accounting income is going to be less than taxable income. In the same manner, if accounting income right now is less than taxable income, then that means at some point in the future that the relationship will reverse and accounting income is going to be greater than taxable income. When we talk about future taxable amounts and future deductible amounts, future taxable amount, which we're going to abbreviate with FTA, this means some temporary difference is going to cause taxable income to be greater than accounting income in the future. And a future deductible amount is just the opposite. That's a temporary difference that's going to cause future taxable income to be lower. Right, we can again look at the example we used earlier for this to kind of get a basic example. So earlier we said a company sells $10,000 worth of goods on account in 2018. They collect the $10,000 in 2019. So we said in 2018 we have accounting income of $10,000. Because once we've made the sale, even if we haven't gotten the cash, we can recognize revenue or income. However, for tax purposes, we can't recognize the $10,000 in revenues until we collect it in 2019. So we have taxable income of 0. So in 2018 then, we have a future taxable amount of $10,000. Since this $10,000 would be taxed in 2019, which is causing taxable income to be greater than accounting income in 2019. Since we have a future taxable amount of $10,000, that means in the future we're going to have to pay tax on this $10,000. Since we're going to be obligated to pay the tax, we then need to record a liability. So this future taxable amount, this will lead to what is known as a deferred tax liability. For short, we can just call the deferred tax liability a DTL. So this example here refers to a situation in which future taxable income will be greater than accounting income. So more generally, if we go up to what we were looking at up above, when taxable income is going to be greater than accounting income in the future, we have a DTL. If we just reverse that situation around where taxable income in the future will be less than accounting income, in that case, that means we'll pay less taxes in the future, which then means it leads to a deferred tax asset, or for short, a DTA. Now, we said earlier our goal in this chapter was to understand the journal entry we make for income tax payable and income tax expense. Let's quickly go over what we know so far. So if we're going to recognize income tax expense, we would do that with a debit. And if we're going to recognize income tax payable, we're going to do that with a credit. Income tax payable is going to reflect the amount of taxes due over to the IRS as a result of our past year of operations. So to calculate income tax payable, we'll just take our taxable income and we'll multiply by the tax rate. Whenever we have a temporary difference, we're always going to report a DTL or DTA, so a deferred tax asset or a deferred tax liability. In some cases, you might debit a DTA or you might debit a DTL. In other cases, you'll make a credit to a DTA or a credit to a DTL. So generally, the journal entry you'll make will come down to one of these two journal entries. Now, whether we debit or credit a DTA or DTL will depend on what's happening with our temporary difference and how it's going to reverse over the next few years. We'll come back to that in just a second with examples so we can see how we fill that portion in. However, over time, the balance in the DTA or DTL is going to change, and we're going to use that to calculate income tax expense. So income tax expense, we're going to start with our income tax payable. Right, and we're going to add or subtract. So we're going to plus or minus the change in the deferred taxes. So the last thing we need to cover here to understand how to make this journal entry is how to keep track of these changes in deferred taxes. The next couple of slides just give you examples of temporary differences. Again, you don't need to memorize these. They're just here to provide a little bit more structure for you to understand what exactly a temporary difference is. Let's go through a basic example. So let's say we have a company and it has pre-tax financial income of $1,000. In other words, accounting income is equal to $1,000. Now let's assume that $300 of that $1,000 of income is recognized in a later period for tax purposes. So that'll cause taxable income to be lower than accounting income by $300 today, but it also means we have a future taxable amount of $300. Since we have $300 that will be taxed in the future, that means we'll be obligated to pay the taxes on these, so we'll have a deferred tax liability. To figure out the deferred tax liability as a result of this, we'll take the future taxable amount and we'll multiply by the tax rate. Tax rate's given on the next slide. Let's assume it's 30%. So for the deferred tax liability, we'd have $300 times 30%, which gets us to $90 of taxes we'll have to pay in the future. At the same point, we can also calculate the income tax payable if we have taxable income in the tax rate. So if we look above, we're at our journal entry. Our income tax payable is just equal to our taxable income of $700 times the tax rate of 30%, which gets us to $210. So at this point, we could fill in the income tax payable. It'd be $210. In this example, we're not given what the deferred tax or the beginning amount in deferred tax liability is, so let's just assume it's a 0. So beginning balance in our DTL is 0. As we just calculated, our deferred tax liability balance should be 90 as a result of this transaction. Is it 90? So our change in DTL is 90. Since we need to increase our DTL by $90, that tells us since a DTL is a liability, we'll make a credit to increase that DTL by 90. And then our income tax expense finally is our income tax payable plus or minus change in deferred taxes. Here, income tax payable is $210. We increased our DTL by 90. So that means our debit here to income tax expense must be $300. Okay, so we're going to report income tax expense of 300, income tax payable of 210, and 90 for the DTL. So take a second to think about what this journal entry is really saying. It's saying as a result of the past transactions over the past period, we're going to incur total income taxes of $300. Of that $300, $210 is due currently to the IRS, and then the other $90 will be paid at some point off in the future when the income is finally taxed. So the balance sheet's going to capture the amount currently due through income tax payable, the amounts that will be taxed at some point in the future through the DTL, and then the income tax expense, as you know, goes onto the income statement. Let's go through a more complicated example. In 2001, Fabian Company sells merchandise with a $40,000 gross profit on an installment basis. The $40,000 is recorded in the current period for financial reporting purposes, but based on the installment method for tax purposes. So in other words, when the company sells this merchandise with a gross profit of $40,000, it can recognize that gross profit for accounting purposes immediately. However, for tax purposes, it can't recognize the gross profit until it actually receives the cash. So let's assume that the installment method results in taxable income of $18,000, $12,000, and $10,000 over the years 2001 to 2003. So in this case, we have this merchandise sale. It's causing accounting income to be $40,000 in 2001 and taxable income to be $18,000 in 2001. This is what's known as an originating difference. Right? After the originating difference, since everything's going to be taxed at some point, the difference is going to be reversed. So when the company actually receives the cash of $12,000 in 2002 and the $10,000 of cash in 2003, these are what are known as reversing differences. So if we go back to our example, in 2001, taxable income will be lower than accounting income by $22,000. Right, and these differences will reverse in 2002. We're going to recognize $12,000 more of taxable income. And in 2003, we recognize $10,000 more of taxable income. Right, so if we're trying to figure out how to make the journal entry for this, again, first place to start will be to figure out what your taxable income is. So let's say in addition to the installment sale income, assume that Fabian Company had other income of $100,000 that is included in both accounting income and taxable income. Tax rate is 40%. So our accounting income will include the $100,000 of other income, and we had, from the previous slide, $40,000 of installment income. So in total, our accounting income is going to be equal to $140,000. To get to our taxable income, we need to just make the adjustments to accounting income to derive taxable income. So we said in 2001, taxable income will be lower than accounting income by $22,000 because of this temporary difference. So we're going to subtract that $22,000 from accounting income to get to taxable income. So this $22,000 difference here will be taxed at some point in the future. We said $12,000 of it will be taxed in 2002. $10,000 of it will be taxed in 2003. So we can draw a table here to include these future taxable amounts. Right, so these future taxable amounts in total to $22,000. At this point, we could calculate both our deferred tax liability and our income tax payable. Right, we just need to know what the tax rate is. So if we take the taxable income of 118, multiply and assume a tax rate of 40%, if we multiply these two numbers together, we get to our current taxes payable of $47,200. So if we wanted, we can make a debit here for income tax payable, for 47.2. Since we have future taxable amounts in this example, if we take these future taxable amounts in total of 22,000 and we multiply by the tax rate of 40%, we can determine our deferred tax liability. So $22,000 times 40% gets us to $8,800. Let's just assume in this example, again, that our beginning balance in our DTL is 0. We want our ending balance to be equal to 8,800. So here our change is going to be an increase of $8,800. So to increase a liability account, we're going to end up crediting our DTL for $8,800. And then as we said earlier, the last step would be to plug in your income tax expense, which is equal to your income tax payable of 47.2 plus the change in deferred taxes of 8,800. So our deferred tax expense would just be equal to the sum of these two cells, so 56,000. Right, and that's what we have on the next slide. So before we get into the next year of this example, let's just quickly create a T account here for DTL, since we need to keep track of the change in deferred taxes. So as of the end of 2001, our ending DTL balance was 8,800. All right, so now let's go to 2002. In 2002, the temporary difference begins to reverse. So in 2002, we're going to collect $12,000 of the installment sales in cash. So this will cause taxable income to exceed accounting income by $12,000, all else equal. Let's also assume that we have $100,000 of other income that is the same for tax and books purposes of $100,000. So our accounting income is just going to be the $100,000. Again, first step, we'll reconcile that to taxable income. Since we're going to collect the $12,000 of installment sales of $12,000 in 2002, that'll cause taxable income to be greater than accounting income by $12,000. So that brings our taxable income to $112,000. Again, we could just take the taxable income, we can multiply it by the tax rate to determine our current taxes payable of $44,800. Again, the current taxes payable will be reported as our income taxes payable. So we can make a credit here for $44,800. Now to figure out the change in the deferred tax liability, we need to figure out what our future taxable amounts are. If you look back at the previous slides, or if you remember, it tells us that $10,000 of the installment sales will be collected in 2003. So when it's collected, it'll be taxed. So we have a future taxable amount of $10,000. If we multiply that by the tax rate of 40%, we get out to a deferred tax liability of $4,000. This $4,000 is our desired ending balance for DTL in 2002. So to get from an $8,800 balance to a $4,000 ending balance, we'd make a debit for the difference. So our debit here would be for $4,800, and that's going to be our plug number. Since we need to make a debit to DTL for $4,800, we can carry that over to our journal entry. We'll make a debit for $4,800. The last part of the journal entry, as we mentioned, we need to record income tax expense. Income tax expense is just your income tax payable plus or minus the change in deferred taxes. Here, deferred tax liability is decreasing from $8,800 to $4,000, so it's making a decrease of $4,800. So as we know our debits must equal our credits. So we'll take the $44,800, we'll subtract out the $4,800, which means our income tax expense will be $40,000. And that's what we see on this next slide here. To finish up with this example, let's go into the third year. So now in the third year, or 2003, let's again assume accounting income is 100,000. And then in 2003, the temporary difference completely reverses. So again, 2003, the company's going to collect the last $10,000 of the installment sales. So that'll cause taxable income to be greater than accounting income by 10,000. Right, but by the time this reverses, there's not going to be any more future taxable amounts or future deductible amounts, so we don't have any deferred tax consequences. Again, though, to account for this, we'll reconcile taxable income to accounting income. A taxable income is greater by the $10,000, so we have taxable income of 110. Again, we can start making our journal entry for this. Income taxes payable is just your taxable income times the tax rate. So in that case, or in this case, it's 44,000. In this case, the deferred tax liability is going to completely reverse, or the temporary difference is going to completely reverse. So now if we extend this down, right, we had a $4,000 balance at the end of 2002. At the end of 2003, we want a zero balance since the temporary difference will have completely reversed. So again, to get from a credit balance of 4,000 to an ending balance of 0, well, we would have to make a debit here to DTL for 4,000. So same thing here. We're going to debit DTL for 4,000 to bring it down to our desired ending balance. And then the income tax expense is your income taxes payable plus or minus the change in deferred taxes. Since debit must equal credits, we can take the 44, we'll subtract out the 4,000, and that gets us out to our income tax expense of 40,000.